Hello everyone, I am Agba Samuel Odi back on your screen, and in this video in this series I will be going about teaching the strategy I use, or my profitable strategy I use trading the financial market. And this key concept on my strategy will be market structure, liquidity, POI, and order block, discount, and premium zone as well. So these are the basic things I use to trade the financial market. But in this video we'll be talking about the first key concept in my trading strategy, which will be market structure. So firstly we'll be talking about market structure. So market structure, now we have three basic market structure, which is uptrend. When you see price creating higher highs and higher lows, this is considered to be an uptrending market, which signifies buyers being the predominant people in this market. And we have the downtrend, when price creating lower highs and lower lows. This is considered to be a downtrending market, which is predominantly controlled by the sellers in the market. And we have the ranging market, which is just equilibrium between buyers and sellers. It can also be called a consolidation market or a ranging market, as it states. So remember that this market is an uptrending market, which is predominantly controlled by buyers, and this market is a downtrending market. Which is predominantly controlled by sellers, and this is a ranging market or a range market, which just signifies equilibrium between buyers and sellers. So this is for sellers. This is a sellers market. This is a market for sellers, and when you see price creating higher highs, that the last high, this high is lower than this high, and this high is lower than this high, and watch, this low is lower than this low, and this low is lower than this low. It signifies an uptrend. So you want to see price take out previous highs or recent highs in an uptrend and protect previous low. We don't want to see previous low get violated, and it signifies an uptrending market, which is for buyers. And for this case, you see price creating a high, creates a lower high, and creates a lower high again as well. So now we want to see the lower highs being protected. We don't want to see price violating those lower highs in a selling market, and we want to see it also creating lower lows. So what do we want to see? For price to be taking out its lows and protecting what? Its highs. We don't want to see the highs taken out in a downtrending market, but we want to see the lows get taken in a downtrending market. And for the ranging market, we just want to see like levels that market is like tapping on the market. This one is like no one is in control, like both the seller and the buyer, no one is in control. So this is the basic three market we have, which is an uptrending market, a downtrending market, and a range market. So an uptrend is for buyers, downtrend is a selling market, and ranging market is just a static market that both the buyers and sellers are just playing off simple levels. So now in this market also we have what is called an impulsive move and a correction move, an impulsive move and a correction move. So now the impulse move is considered to be, okay, let me clear the chart so that I'll explain more. So in an uptrending market, an impulsive move is where you want to be interested in, the moves that makes the high pip count, or however you call it. So an impulsive move signifies where buyers engage the market, so that is considered to be an impulsive move. So in an uptrend, this is an impulsive move, this is an impulsive move where buyers got in, this is an impulsive move, and this is an impulsive move for the uptrend. So these are the places you would want to engage on the buy trading an uptrend. And for this, for downtrending market, this is the impulsive move, this is the impulsive move, this is the impulsive move, and these are the places you would want to engage in the market. So now the correction move is like the move that is against selling activities or buying activities in the market. For example, we've stated that an uptrend consists of higher highs and higher lows. So we've established that in an uptrending market, we want to see price protecting lows, protecting lows, protecting lows. And now for you to trade an uptrend safely, when you see an impulsive move, there is how the market is being traded. When you see an impulsive move, wait for correction, and when you see an impulsive move again, wait for correction or pullback. When you see an impulsive move again, wait for correction to join in again. So now the correction simply states that it's more like a retracement phase where sellers get involved to push price lower for buyers to join in again. So that is simply what a correction phase is. So now this is just the basic market structure. This is just the basic market structure.